Welcome to the InterMarket Analysis video update. This is a video that I do once a week that looks outside of the S&P 500. It looks at other stock indexes. It looks at other markets. It looks at different sectors to try to get some insight or clues as to what's happening in the market overall. And we're seeing some real improvement in the stock market right now. We are overextended to the upside, so to see a bit of a pullback from here would not necessarily be a surprise. But we're also in a positive seasonal time, and so we could see stocks continue to go higher from here. But we also want to keep an eye on some other areas of the market because that can have an influence on stocks. This is being prepared for Monday, December 18th. The first area that we look at, and there's a few different charts that I have this time, we look at S&P 500 valuation. How is the S&P 500 valued? There are times when it's overvalued, and those that follow the fundamental analysis approach to investing, they might look at selling at such a time. They may not use technical analysis, but when something gets expensive, they might sell. When something gets cheap, they might buy, and then they just hold on to it until it switches from one to the other. Well, when we look at this here, we look backwards at historical PE ratios is what they're called, the price to the current earnings that have already been given to the market. And then we look at how they're applying right now. And then we also look forward. And it's some of those forward charts that I have a few different charts to show you because I didn't have access to the charts that I usually have access to. So looking at this, we have a PE ratio that goes from 10, 15, and 20. 10 or below is considered inexpensive. 15 is considered fairly valued. And 20 is considered expensive and above. And then we plot the S&P 500 on a closing basis on the black line here, and you can see that we're well above the red line. So on a historical basis, we are expensive. Some folks get really concerned when this happens, but you can see that we can be expensive for many years at a time. We can also plot this down below. This red line here is just the spread between the current price of the S&P and the PE ratio of 20. We can also plot this and look at different historical events that have happened going back to 1980 to see what were the market valuations at that time. Then we look at a slightly different way here called the Shiller PE ratio, where this looks at an average over a period of time to try to get things more smoothed out. And right now, you can see over on the right-hand side, the S&P has a Shiller PE ratio, which is also called CAPE sometimes. It has a reading of 31.92. Well, to give us some perspective, we can see what that is historically, and this is actually looking kind of high, especially, it used to be marked on this chart, but it's no longer marked. We have the 1929 crash, we have the 1987 crash, and we're about at those levels that we've seen before we saw big downturns. But that doesn't necessarily mean that prices are going to crash from here, but we want to be aware of this. Also, to give us some other context, we look at the median and the mean, which is anywhere from about 16 to 17, and currently we're almost at 32, so we are also considered to be expensive. But the market doesn't do that. It looks forward using forward PE ratios based on industry analysts and projections and forecasts, and this is different than what you've probably seen before if you've watched any of these other videos. Right now, based on the Y chart, we are at 21.54. So we're a little bit expensive when we look at things going forward. The other charts that I look at are still under 20, at least the last time I saw them. And so there's a little bit of change or modification depending on how these are calculated. So we're considered a little bit expensive going forward looking at this chart where we're under that 20 level when we look at the other charts. And I couldn't find one for the mid caps. This is the forward PE ratio for the small caps, which are still pretty low, especially when you compare them to their historical average, right around 15 or so. That would be fairly valued. And even though small caps have been going up, they're still considered to be inexpensive, especially when you look forward at prices. Then another area that we look at is growth versus value. Growth is when you want to buy low and sell high. Value is when maybe you want more of an established company that may pay dividends, that stood the test of time. And we can compare these areas. When the market's really going up, it tends to favor growth stocks. When the market is going sideways to down, it may be favoring value stocks. So the first index that we look at is just a growth index, and it is showing some improvement, and we're actually starting to see a golden cross here after it had been chopping more or less sideways. Then we look at a value index, which is also showing some improvement, but is still in a longer-term downtrend. Where this gets interesting is when we compare the two with each other and to take a ratio where we look at the growth to value ratio. Now, this is a bit of a concern. The market's really been going up lately, but we're seeing the growth to value ratio going down. Taken another way, this is an inverse on the bottom where value has been going up as the market has been going up. Does that mean the market's anticipating something maybe into 2024 where they're getting out of growth stocks and getting into value stocks? Yeah, but we've been watching this for a while now, and we'll continue to watch this, and it's a bit of a warning sign for right now. We also look at this many different ways. We look at some ETFs where we're still in a longer-term uptrend when we look at the growth to value ratio with this ETF, but we have been declining lately. Here's an inverse showing that we're still in a downtrend with value, but we have been showing a bounce here. We also look at some other indexes on a broader measure here, longer term chart, where we're still in an uptrend, but we have been falling back. This is showing more scrunched up, looking at a shorter time frame, where value is still in a downtrend, but has been starting to perform better. And then we look at another ratio here showing where growth is underperforming value. We also take another measure of growth to value, looking at some different ways of measuring this, where we have been coming down with the growth to value ratio. It's still positive and it's still hanging in there, but we want to see this going back up, and it really hasn't been doing that. Here's an inverse of that same chart showing how value has been underperforming, but it has been bouncing back up lately. Then we look at the small caps, and we want to compare the growth to value ratio for that, where we've been chopping more or less sideways. We're below both of the moving averages here, and we're in danger of actually seeing a death cross with this ratio. But we've been seeing the small caps really show some improvement, at least when you look at the index. We're not seeing an awful lot of follow through with the growth to value ratio. Things are looking a little bit better when we look at the mid caps, and they've been going up lately too. And we're seeing a lot more strength here in this overall ratio. It's not really breaking out necessarily, but it's still looking more positive. Then we look at the S&P 500 growth to value ratio, where the S&P has been going up and this ratio has been going down. That's a bit of a warning sign, something we just want to be aware of. We ultimately follow price and have to go with that, but this is just telling us that maybe there's something a little concerning under the surface. We also keep an eye on inflation, where we look at a monthly chart of the CRB index, where it's been chopping more or less sideways. Then we have a ratio on the bottom, which looks at inflation versus deflation, and we're below the moving average, even though it's been ticking back up a little bit here. But inflation has been really dropping off, and we've seen that in some of the most recent economic reports, even though it did tick up a little bit recently. Then we look at just at the CRB index itself. This is a daily chart where we're still in an uptrend, but we've been really showing some weakness here, almost deflationary. If we start to go down more with price or stay underneath the moving averages, this could be generating a death cross. We look at the Baltic Dry Index, which when this is going up, that means it costs more to ship things from point A to point B in the Baltics. And this had been spiking up, but now has been starting to come back down, but it's still in a longer term uptrend. Some other markets, we don't trade these markets. I just keep an eye on these markets. I look at them about once a week and then kind of on an as needed basis. Here's the aluminum market, which is still in a longer term downtrend. Corn is continuing to be in a downtrend. Wheat is also in a downtrend, even though it's been bouncing back up. We look at fertilizer, which has been longer term in a downtrend. It did bounce back up and is now starting to come back down, even though it bounced up in the most recent reading. Oil has been all over the place, and this has been caused more geopolitically. When things started to break out in Israel, that's when we really spiked up to 95. And since then, we've been falling back, and we're in the low 70s right now. Gas is also in an overall decline, which is probably pretty welcome for most people that have cars and trucks. And we look at diesel, which has also been declining lately as well. That's also not really showing any inflationary pressures. Heating oil is also continuing to come down, even though it's still in a longer-term uptrend. Natural gas is still in a downtrend, even though it's been bouncing back up. Now it has been starting to decline again. Copper, which is more of a barometer of the economy, when it's starting to go back up, that means things are looking better economically. When it's going down, that means things are not looking as good. We're still in a downtrend here, but copper has been trying to rebound lately. And then we look at the copper to gold ratio. When there's a lot of inflation, when there's a lot of geopolitical unrest, that's when gold does well. When copper tends to outperform is when things are looking better economically. Well, lately we've been seeing the copper to gold ratio showing that copper is outperforming gold. And then we have a longer term version of that chart where we're showing that the longer term ratio, which is black, that continues to decline as the copper to gold ratio has been declining. And then we also plot the 2-year yield in green and the 10-year yield in red. And these have been coming down, but there's still a really wide spread between all three of these. If you look at other times, they tend to not get all that far apart from each other, even though they're on different scales, and they tend to go in the same general direction. Now they're kind of going in the same direction, but for the last 1.5 to 2 years, they haven't been doing that. We look at gold, which really spiked up when things started to happen geopolitically in Israel, and then it's starting to fall back. It's trying to bounce back up, but seeing some recent weakness. However, we are in a recent golden cross with the gold ETF. Silver is still in a downtrend, and it's been going up and down more or less with gold. And we look at the end of day prices for gold on the top and silver in the middle. On the bottom, we just see that there's a pretty strong correlation between the two. They could both be going up or down, but they tend to be going in the same direction at the same time. Then we look at the gold to silver ratio on top, which lately has been declining. We also have a chart down here of the US dollar index, and we're seeing where this relationship is not as strong as it has been in the past. Sometimes we can get some insight by looking at this chart, but we're not really getting all that much right now. The dollar has been showing some weakness lately as stocks have been going up, and if we see stocks continue to go up, we might see further weakness in the dollar. We look at the euro, which has been coming back up against the dollar. And when we look at the Japanese yen, it's also bouncing up. I have individual charts here. Here's the euro, which is still in a downtrend compared to the dollar, but has been showing some improvement. The Japanese yen is still in a downtrend, but lately has been really surging back up to the 200-day moving average. And the British pound also is in a downtrend, but showing some real improvement. If we see more weakness in the dollar, we're probably going to see these other currencies outperform the US dollar. Looking at some indexes, for a long time, we've been concerned that the equal weight index for the S&P has been underperforming the weighted version of the S&P. Now we're starting to see that shift a little bit as the red line is coming up and starting to outperform the other index. That's just suggesting that there's more broad participation with more stocks than just the big mega caps. Then we look at a ratio of the S&P 500 to the CRB index, showing that stocks are outperforming, and we're seeing a recent golden cross with this ratio. Here's an inverse of that same chart showing how the CRB index is underperforming. And you might wonder, why do I have this and then I do an inverse? Sometimes when you look at things in a slightly different way, you get some insight that maybe you might have missed by looking at it just one way. Then we look at a ratio of the NASDAQ 100 to the S&P 500. Both have been doing well. Both have had good years in 2023, but the NASDAQ 100 is still outperforming. The S&P 100 is showing a little bit of weakness here compared to the S&P 500. That's something we want to keep an eye on. These are the bigger stocks, and we would normally see these really start to outperform as stocks have been going up, and we're not seeing that right now. The NASDAQ to S&P 500 ratio shows that the NASDAQ is outperforming. And even though the NASDAQ 100 and the NASDAQ have been doing well, the NASDAQ 100 has been doing even better. We look at the mega caps, the big companies, and compare it with the equal weight index, showing that the mega caps have been pulling back a little bit lately, but they've really been leading the charge higher in 2023. This is also encouraging. We're seeing the small caps to S&P 500 ratio show some improvement. This red line is starting to go back up, as is the blue line, which is the S&P. That would be healthy if we could see some sustained growth. Now, we're in this time of year where we're trying to figure out, are we going to experience what's called the January effect? This typically starts about the middle or so of December. It may have already started now. We don't know if it's actually going to continue, but typically what will happen is small caps will see more favor at this time of the year going into the beginning of the next year. We also see some favor in mid caps right now, wondering if that's going to continue. So far, it looks like it has been happening. We just don't know if it's going to keep going. Then we look at the ratio between the small caps and the S&P, where the small caps have really been underperforming, but lately they've been bouncing back. We want to see this continue to go up and eventually see a golden cross with this ratio. We look at the biggest software companies in the US, where we're just barely getting back to the point where we might see a golden cross here after it had been seeing some weakness. The mega caps still continue to do quite well and are in a pretty solid uptrend, but they're not quite back to their all-time high yet. And we look at the robotics ETF. and AI, where it is starting to show some improvement as well, where it really had been seeing some weakness. But when you look at it compared to the tech sector, yeah, it's bouncing back up a little bit, but it has been underperforming for quite a while. We look at the Dow Jones Composite Average, which is the Dow, the transports, and utilities. This is showing some improvement, and we're starting to see a golden cross here. This is rather encouraging. We look at the S&P 500 and compare it with shorter-term bonds, showing that stocks are outperforming the shorter-term version of the bond ETF. Then we look at a broad market measure and look at further out bonds, showing that stocks are also outperforming on a broader range. And we look at low volatility stocks, which have been bouncing back up lately, but they're still in a longer-term downtrend. And when we look at the ratio between the low volatility ETF and the S&P, we're starting to break down here, where in 2022, these stocks held up a lot better. In 2023, they've been really underperforming. We thought we were setting some kind of support down here. Now we're starting to go down even more. And we look at the tech sector and compare it with 3 to 7 year bonds, showing that tech is outperforming bonds. And then we look at some other stocks. Here's the advanced decline line studies. And I show this every day in the daily video, where we're still looking pretty strong across the board with our advanced decline line studies for the NYSE common stock, the S&P mid caps and small caps, even though in Friday's session we did turn down. The Dow has been breaking out and setting new all-time highs. But one thing that has been discouraging here, or a warning sign, is that we're not really seeing participation from the transports. We're breaking out above this previous high with the Dow. We're not even back up to this previous high with the transports, even though they are showing some improvement. In a more solid environment, we want to see the transports actually outperforming the Dow. And then as interest rates have been coming back down, we've been seeing some weakness in utilities. And here's another look at the transports to S&P 500 ratio, where it is ticking back up. But we want to see this really doing a lot better than it's been doing lately. Here's the Dow to transports ratio, where we've been chopping more or less sideways recently. And here's a relationship between the S&P and the transports, where they're having kind of a strong correlated relationship. Typically, it does get stronger than this, just meaning that they're moving in the same direction at the same time. Then we look at a new take on Dow theory, where instead of using the Dow, we look at the S&P. Instead of using the transports, we look at the NASDAQ. And we're seeing confirmation here. We're breaking out with the S&P. We're also breaking out with the NASDAQ. So these are confirming each other, where if you go back to traditional Dow theory, we're seeing a non-confirmation right now because the transports are not breaking out. But this can take some time. If people see this and they go, oh, look at this, there's a divergence here, it's negative. Well, sometimes they don't happen at exactly the same time. Now, if this continues to go on, yeah, we'll be concerned, and we're going to be concerned until we see some improvement here. Then looking at the FANG index, which is now back to setting all-time highs. That's Facebook, Amazon, Apple, Netflix, Google, and a bunch of other big mega cap stocks. They're just continuing to do quite well. And we're starting to go back and break above previous resistance, and we're setting all-time highs with the FANG index. ARK is seeing an improvement, and we're actually starting to see a golden cross here as it's been bouncing back up. Then we look at the S&P 500 on a monthly chart, and we take a ratio of international stocks that are based in Europe, Australia, Asia, and the Far East. And when this is going up, that means the S&P is outperforming, and we're continuing to go up, and we're above the moving average. Also on a momentum basis, we're seeing the PPO above zero and continuing to advance. That's positive. Then we keep an eye on bonds, where we're still in a downtrend with the total bond ETF, even though bond prices have been bouncing back up. We look at world bonds, also the same thing, downtrend, but we're seeing some bouncing lately with price. And even though this is rolling over a little bit on the monthly chart, stocks are continuing to outperform bonds. On a shorter term look here, bonds are underperforming stocks. And these are high yield bonds, which we often call junk bonds. They're just continuing to do well, and they tend to pretty much mirror what's going on in the stock market. Where these are more conservative bonds, they're still in a downtrend, but they've really been making a comeback lately. We look at the ratio between riskier bonds like junk bonds and more conservative bonds like government bonds, and folks are still tending to prefer the more risky bonds because they're giving a lot higher yield. They're willing to take on the risk to get a greater return. Then we look at a correlation between stocks and bonds, and they're having a fairly strong tendency to go in the same direction. We look at the Dow Jones Corporate Bond Index, which is still in a downtrend, but really starting to show some improvement. Here's the 10-year yield. We're seeing we almost got up to the 5% level, and we've been coming back down lately as interest rates have been falling. We're also looking at a longer term chart here where we're falling with the 10-year yield, and this chart goes all the way back to 1980. We look at the 30-year yield, which also has been declining lately. And then we look at the S&P 500 with the rise or fall in interest rates, and it's showing that the S&P is really outperforming the rise or fall in interest rates right now. Junk bonds continue to do quite well. And we look at the junk bonds, which are more risky, and the bond ETF, which is more conservative. This has actually been pulling back a little bit lately. We're seeing this ratio coming down where it had been a lot stronger. And then we look at the 7 to 10-year bond ETF, where we're seeing a lot of improvement based on price. We're looking extreme with the RSI. We're back above the 200-day moving average, but we're still on a longer-term downtrend. But on a shorter-term basis, we are positive with the MACD. We're looking at a daily chart of the different maturities with their yields, and we can see that overall yields have been coming down. Here's a weekly chart looking internationally, where we're also seeing a real decline in US, UK, and German rates, also a bit of a decline in Japanese rates. Then on top, we have the MOVE index, which measures the volatility of bonds, and they've been chopping around a little bit more, where the VIX is continuing to go down. This measures the volatility of stocks, and their relationship is not as strong as it has been before, but they're having a pretty strong tendency to go in the same direction. Then we have a monthly chart of the price of the 30-year bond. That's still in a longer-term decline, even though it's showing some improvement and coming back up to the moving average. This is a monthly chart. And then on the bottom, we take a ratio of the longer-term bond ETF with the CRB, showing that the longer-term bond is continuing to outperform. Then we look at different sectors. We compare, there's 11 sectors in the S&P universe, and we take those 11 sectors and compare them with how are they performing against the S&P 500, where materials are underperforming. Communication has been a stronger area. They're outperforming, even though they've been pulling back lately. The energy sector, which was trying to break out, is now breaking down compared to the S&P 500, and we're actually seeing a death cross here with this ratio. The financials are finally starting to come back to life. We're breaking above the 200-day moving average with this ratio. The financial sector is actually in an uptrend right now and showing a lot of improvement. The industrials are showing some improvement as well, but still in a longer-term downtrend. The tech sector continues to be strong. The staples continue to be weak. Real estate is showing a bit of a rebound here as interest rates may be starting to come down, and that's good for the real estate market, even though we're still in a long-term downtrend. Utilities are also continuing to be in a downtrend, and if rates continue to fall in the interest rate area, we'll probably continue to see utilities be under pressure. Then we look at the S&P to utilities ratio. When this is going up, that gives support to the S&P. We've been doing a lot of chopping around lately. And here's healthcare, which is continuing to be in a downtrend. Here's another look at healthcare showing how it's been underperforming on a ratio basis. Discretionary showing a little bit of life here, but not really breaking out above these previous highs, but still in a very weak uptrend currently. The staple sector, which has been under a lot of pressure, has been bouncing back lately, coming back up to its 200-day moving average. The tech sector still is continuing to look pretty strong. The semiconductors, man, they're just really breaking out and looking really strong at the present time. The tech to S&P 500 ratio shows that tech is really outperforming, and then energy is underperforming the tech sector when we look at a ratio there. Then we look at growth stocks, which have been really outperforming bonds, but lately we've been seeing a little bit of weakness in this ratio. The tech sector to the rise or fall in interest rates show that the tech sector is really outperforming. Here's an inverse of that same chart showing how the rise or fall in interest rates are underperforming. And then we use a ratio looking at discretionary versus staples. And it's not that discretionary is doing great. It's showing some improvement, but it's more that staples have been under a lot of pressure for much of 2023. So it's showing that discretionary is outperforming staples. This is an inverse of that same chart, showing how the staples are underperforming discretionary. Looking at gold, where it's starting to underperform the S&P 500 and is in a longer-term downtrend when compared to the S&P. It's also falling back just a little bit here, but trying to break out above this trend line when we compare gold to the dollar. High leverage loans continue to look pretty strong, which is suggesting that the economy is looking okay for now. The NYSE composite is starting to generate a golden cross again. That's a broader measure and showing more improvement. International stocks are also looking more positive, as well as US stocks. Emerging markets, though, we're chopping more or less sideways. We're still in a longer-term downtrend. We're hoping to see if this will show some improvement. The micro caps are showing some improvement, and we're still above the 112 level. And the housing or home builders ETF, it's still continuing to do quite well. We're not really seeing any divergences here. It's more of a convergence where they're both tending to perform well lately. Bitcoin is also in a longer-term uptrend, even though it's been falling back lately. And internationally, China, emerging markets are in downtrends. We're pretty much sideways. When we look at Europe, Japan is sideways, and we're showing a little bit of improvement, but still pretty much going sideways at the S&P. And this is the KST. This is another momentum oscillator, but it's longer term. Then we look at InterMarket Analysis, which is the name of this video, going back to the beginning of 2023, showing how stocks are doing the best, followed by gold and then the dollar. And now bonds have been able to turn back positive, where oil has now gone negative going back to the beginning of the year. Then we look at some different correlations. The S&P 500 to the dollar, they're having a pretty strong tendency to go in opposite directions. If one's going up, the other one's going down. S&P to oil, it's pretty much neutral now. When we're in this red area up to the blue area, that's what I consider to be neutral. We look at the relationship between the S&P 500 and the 10-year yield, where they're having a pretty strong tendency to go in opposite directions. And the tech sector to the 10-year yield also tending to go in opposite directions. Then we look at a shorter maturity here, the S&P to the 2-year yield, also opposite directions. And then some long-term studies here. This is a monthly chart of the NYSE composite, and we're starting to show some real improvement here and looking better longer term. We're also looking okay when we look at the momentum measured by the Kopic curve. Here's a daily chart of the NYSE showing some improvement on top, and we're starting to go back up with the NYSE record high percent index. When this is going up, that's more positive. And then we look at the S&P on a monthly chart where it's still above its longer-term moving average. We're also showing where the PPO, which is a momentum oscillator, continues to be positive. And then we look at a ratio of the S&P 500 to the CRB, showing that stocks are continuing to outperform the CRB index. And then we look at a monthly chart of the S&P 500 and another global index, showing how the S&P 500 is outperforming. The KST is still slightly negative, but another month or so, and this could potentially cross over positive. Then what I do at the very end of this video, I have a very simple definition. I list those things that are positive and negative. My definition of positive is when the 50-period simple moving average is above the 200-period simple moving average. Now, I know that's really simple, and sometimes the lagging part of that can be kind of frustrating, but I had to cut it off somewhere here in the definition. But those things that are positive, a new addition back on this list are the growth indexes and ETFs. The CRB index, even though it's been showing some weakness, is still positive. The dollar also weakness, but positive. Gold is still in an uptrend, showing a little bit of weakness lately. The mega caps are still quite strong. The FANG index, ARK, is now back on this list again after having been negative. The Dow Jones Composite, another new addition that had been off the positive side for a while. When we look at high yield and junk bonds, the more riskier bonds, they're still doing okay. The tech sector, as well as semiconductors, high leverage loans, the Dow, the NYSE composite, which is now back on the positive side, the NASDAQ and NASDAQ 100, all stocks, and then at the very bottom, if you can see that, is Bitcoin. Then we look at the negative side, where we look at the 50-period moving average dropping below the 200-period moving average. The value indexes, even though they're charging back, they're still in a longer-term downtrend. Silver is still in a downtrend. Copper is in a downtrend. The Japanese yen, the euro, and the British pound, when compared to the dollar, they are bouncing back, but they're still in longer-term downtrends. The biggest software companies are looking a little bit better now, and the low volatility ETF still in a downtrend. Staples, the total bond ETF, world bonds, the mid caps, the small caps, and the micro caps. We're still in longer-term downtrends with all of those indexes. Emerging markets, investment grade, as well as corporate bonds as well. Thank you. I hope you found this helpful. Please feel free to check out the daily video that I post as well as the weekly video. This is just one video that I do each week. It's okay if you just watch this video, but you could probably make more use of things if you watch all of the different videos that I post. I hope you have a very good weekend, and I will talk to you in the next video.